Good morning, everyone. Thank you very much for coming. I'm Mike Phillips, UK editor at BisNow, and very grateful to have a wonderful panel up here to discuss investment and valuation and digital transformation and everything pertaining to that. I'll ask you all to introduce yourselves very, very briefly, starting with Tatiana at the end. Keep it brief, like I'm going to cut you off after 20 seconds if you start to ramble.
Thank you. My name is Tatiana Tezel. I'm a deputy fund manager at Blackrock for value-add, closed-ended property fund investing in Europe across really commercial and residential sectors.
Great. I'm Stephen Walker from Aberdeen Standard Investments. I head up our UK business-based portfolio management team, and I also head up our PropTech team, which is a global team analysing and looking at new technology and basically serving as a link between the house and the tech sector.
Hi, I'm Shaforostova, CBRE investment advisory team. I'm responsible for business development and product specialist, working with investors to develop the investment strategies and also manage the funds on their behalf.
Hi there, Magnus, Svantegard. I have two hats here. I'm first of all head of product since 18 years for Datscha, a database keeping track of all commercial buildings in England, ownership and market information, transactions. The second hat, I'm a senior advisor to our owner, Stronghold Invest, and among other things, we own the largest property consulting firm in the Nordics. So we have, for example, 31 million square meters under management.
Brilliant. So we have an investor, an investment asset management manager, an investment advisor, and a PropTech CPO. So a brilliant range. And also, I should say as well, Lisa also has a 6-week-old son. So she's shown a commitment to PropTech to be here that I doubt anyone in this room can match. So congrats to her. Start off asking people from the investment side. Stephen, how are investors like Aberdeen using PropTech technology, more sophisticated data and digital tools to make smarter investment decisions?
Well, to kick off controversially, I think if we're looking at pure appraisals of investment opportunities, I think that most houses and most propcos probably aren't using data to make those decisions. I think they're probably being approached in a pretty similar way. But what I would say is I think the data that's being used in those decisions is being captured in a much more sophisticated way. So I think there are lots of sales people with lots of new ideas and lots of technology that could potentially work, but I think we're not quite there yet on that journey. And I think getting to the stage where we have sort of universal data sets where we can compare buildings on a really quantitative basis is coming, but it's not quite there.
And what will that allow you to do think, as an investor? Where, if we reach that promised land, what would be the ideal for you, and what would it allow you to do as an investor?
I think in terms of the comparison of buildings, often we look at what the lease length is right at the moment. What is the tenant lineup? How does that look? What we can't see, really looking backwards, is what was the tenant retention rate in that building? What is the void rate over the last 3 or 5 years? How quickly did you let those suites? And that's the sort of quantitative data that I think lets us really compare those buildings and analyse the buildings that really, perform differently to other properties.
Sure. Tatiana, from your point of view, you're more of a value-add investor rather than a sort of core investor like Aberdeen Standard. How are you using data and sort of technology over at Blackrock?
Yeah, I think it's very similar to what you just said. Over the past, 20 years, the liquidity of real estate has been increasing, and I think the investors who do use more sophisticated data actually do find the kind of cutting edge or get the competitive advantage compared to the, other investors. So, as much as, the increased liquidity and increased transparency helps you to understand the alpha, I think you need to look where the beta is. So that's where we are looking at to add value, and we're actually looking at quite short business plans. And in terms of the sophisticated data, I mean, yes, we would love to actually use, more of it, but I think we are also not, quite there yet.
What would be an example of sort of data that you do have that you're using to generate that? I love that word, alpha.
So any general data that is available as every other investor. So you look at your typical, agents reports. You go and speak to specialist research houses that can connect you with specialists in the field. So, if you're acquiring a hotel, you may want to speak to hotel operators directly or ex-hotel operators who give you the idea, how to run a proper hotel and what you are perhaps missing in your underwrite. But sophisticated data more kind of on the big market trends, I think, that's where more of the potential is. Like, there's so much data which is just not feeding through the property yet.
Sure. Lisa?
Yeah, I think where we are trying to sort of look into more and more is the occupier data. So not just sort of traditional data sets, but where the demand is. So whether it's corporate occupier or the customer or the retail store, where they're going, where the hotspots of talent are, where the occupiers want to be. And then there is a growing demand for this data to understand your customer. And what we're trying to do in CBRE, we have a big occupier team that advises all the major banks or retailers where to open the stores or where to open the next headquarter office. So we're trying to understand what is driving their decisions and then translate this data into the investor space, because traditionally this information hasn't flown so seamlessly. And we believe that this understanding can be so powerful to identify where is the next shortage or where is the next Berlin or where is the opportunity for investors on the longer term, because we can track the major shifts in the way where the demand is going.
And what are the kind of, again, the actual data points that, I'm sure Tatiana and Stephen have been sort of walking the streets of big cities for 20 years trying to work out what the next Shoreditch is or the next, Kreuzberg. What's the data that's actually available now that wasn't available before that are helping to inform those decisions? What kind of things?
Yeah, sure. So I'll give you one example where our colleague Martin Summerscales developed this technology called Calibrate in CBRE, and he is using mobile phone data to track the customers that go into retail stores. And we can now understand in a live fashion where the customers live, so where they go back home. We don't track individuals, but we track sort of locations, and we can do the sort of mapping where they're coming from, what's their disposable income. And then we can understand what's the amount that they spend in the shopping mall through mobile phone data and MasterCard spending data. And this allows us to understand how dominant the retail center is in the location, what's the competition, where else these customers are going. And this paints us the whole picture, how strong the performance of the shopping center is, based not just on the real estate data, but on the technologically enabled data that becomes available as of recently.
Sure. And Magnus, in terms of when investors are coming to you, what kind of things are they asking for, and are they asking for things that aren't realistic as well? Are they asking you to kind of solve problems that are essentially not the place of sort of a PropTech solution to solve?
The main reason we get approached by investors and funds is to use our data to be able to scout off-market deals. Since we track every single commercial building in England and Wales, what type it is, the size, who owns it, who is the ultimate owner, and investment stage. So that's normally the starting point. Very quickly we have started to build in functionality so they can upload their own data and cross-run it. So that's for sure in a growing demand. And I mean, we've been in the business for 20 years, and there's no question that many investors and property funds or large property owners have a long, long way to go. Sometimes you sit in a meeting, you walk through a reception area, it's like 250 square meters on the 20th floor, and you realize that the property managers, they don't really know easily what they own or what they just sold in many cities. You see them almost blown away, because I can show them what their competitors own, but I hardly know what they own themselves. But I mean, the biggest problem is maybe that they are not, I mean, many are nowadays pushing the limits for sure, even though many have a long way to go. But I think the biggest challenge for them is that they need to invest time and money to solve it. To just being able to track your portfolio, what your tenants, how are the tenants doing, being able to do maybe daily or weekly credit runs on your tenant stock, that is nothing you fix in a day or two. So you need to put a lot of internal resources in the processes and respect the data to a much higher level than most people are doing today. We are meeting with so many companies that want to upload their database into our system, and 5 minutes later you realize it's just scattered in different Excel spreadsheets. And Excel is powerful, but it's not the database.
Sure. And Lisa, how far, from your point of view as an advisor to institutions, how deeply do you think what we're talking about has penetrated? So the common or garden institutional investor, when you go in and start talking about big data, analytics, AI, etc., how many of them are on board, and how many of them are still sort of, well, we're all right, but we're doing okay and we don't need that sort of thing?
So I think that it's growing. The awareness is growing. So, and actually, as you can see, I think that it's in the KPMG report recently where they interviewed 300 executives, and the majority of these executives are stating that big data, AI, and machine learning is sort of the key and the biggest opportunity that it presents in the real estate space. So there is a growing awareness. However, no one really knows how it can be applied. So it's a lot of talking, but in reality, so we were trying to apply it even in CBRE to use this sort of, not just even big data, but data, and especially what Magnus was just saying, is just so dispersed. So even when we start talking to investors, it's the data is so dispersed and stored in different files, and it's not consistent, not systemized. So I think the idea of it is appealing to investors. The reality is we haven't really figured out how to use it, how to put it all together, and then start to interpret it. So the next step, I think, for us is to actually aggregate the data and start applying all these technologies to run multiple regressions or multiple sort of analytical iterations to be able to see what are the what the data is telling you.
Sure. And
sorry, Mike, just to jump in, but I think that's a good point. And so with Magnus, the data, I think all of us would agree that capturing data is really valuable, and we should do that. I think the difficulty is, how do you do that, and then what do you do with it when you have the data? And that's a part that I think real estate, in terms of that evolutionary journey, is trying to figure out. Because if you're a really good portfolio manager or a really good fund manager, you've never really had to deal with data before. So it's a whole new skill set, and that doesn't just affect the investment guys on the client side. That affects the letting agents, the investment agents, the rent review guys. That data just becomes more and more important.
so, sorry, Paul.
We see a large trend when we're talking about funds and property owners is that it's easy to have stayed away from all the data and going digital because you're making so good profit anyways and no one else is doing it. But now there are, for sure, funds that are applying technology in a way that they could invest in more properties and more efficient that they were before not able to do. Maybe smaller assets, but a larger number of assets. If you apply technology right, you can find those deals and really push them through the process. Another thing that is really putting the pressure on funds is the need for transparency from their LPs or the regulators or maybe the banks in talks with them, that the external parties is putting pressure for them to really provide up-to-date data extremely quickly and trustworthy. And that puts a lot of pressure internally to really step up to.
Tatiana, you're nodding in agreement there?
Yeah, real-time data. I think that's where the property perhaps lags a little bit behind. Me as a fund manager, do I, if I want to know what is the occupancy rate in one of our properties in the portfolio as of today, not as of 3 months ago or 2 weeks ago. I mean, what do I have to do? I have to go to my asset manager goes to the property manager, and property manager, comes back. It takes about probably, if you're lucky, at least 1 day, probably more than that to get that information. And so there's a huge, I think, space to enhance and improve the efficiency and the speed, not only on the operational side, but also on the kind of investment-making decision.
And, and that's the stuff that should be easy, right? That's the stuff that we should be able to do every day. So we get really caught up in AI and driverless cars and all these things that will come and are really important. But right now, we can be using technology to run our businesses much more efficiently, to communicate with our customers much more efficiently, and to understand what we do internally in a much better way.
On the investment side, I think to your point, Magnus, how do you know when you're bidding for the property that's the right price? You have set of comparables you're looking at, but, do you immediately know day one when you're bidding what it was the building next to the one you're acquiring actually traded, what the building traded for, what was the yield, what was the price per square meter? You don't. You actually have to do the due diligence, speak to the agents, etc., or get access to the, obviously, smart databases which have this information. But the question is also how old is the information? Many of the transactions in real estate, and speaking from my own experience, I worked on a deal that took 18 months to close. One shopping center. I mean, the pricing was agreed 18 months ago and then transacted, at year end, was in the press month later, and that's the current data. So that is, I think, what we are faced with in real estate.
I just wanted to quote one stat which I came across recently where it says that $650 billion is spent in the US alone on the operating expenses related to real estate. And $1 saved on operating expenses generates $16 of asset value. So if we could, to the point that Steve made, if we could just get our data together and clean it up and have it available on demand in a real-time basis, that could generate massive opportunity just sort of on operating side, because to the point that Magnus made earlier, there is a very big pressure on the cost transparency, and the investors are forced or encouraged, I would say, to sign the cost transparency code this year. So pension funds that want to select the investment manager, they would require the investment manager to sign up to this and make all the costs very, very transparent. So there's a big push to benchmark your operating performance, to drive the efficiencies, and also be able to demonstrate value. So you not only benchmark across your funds internally, but also with the market, with competitors, to be very transparent how you drive value, how you reduce your costs, and what you're charging the LPs for.
Sure. Magnus, just to go back to one of the points you made earlier, what are the examples? I'm really interested in that idea of data that can allow you to invest in a different type of property that you might have not earlier, smaller properties, perhaps more sort of non-prime properties. What are the examples of the kind of data that people are using to make those decisions? And give us an example, if you can, of some fund managers or investors that are using that kind of information.
I can give you two examples. One example, I can't name the fund because it's.
I'll go on.
I'm not. But they're looking to purchase much smaller units all over England. And first of all, is to find them and kind of approach them off market. Then also they're aiming to use machine learning to go through all the papers, all the documents, all the rent agreements and so on a very, very larger scale than having maybe high-paid attorneys going through every page to really streamline the process, because they're looking, instead of buying maybe 5 to 10 properties, they're aiming to buy maybe 200, 300 much smaller units. So that's one example. One of my favorite examples, if you listened to me before, you've heard it, and they are very open about it and have been talks, is Fidelity and Matthew Richardson. They have really, really pushed it. Matthew just left Fidelity, and he's now one of the most called people among property funds to go and describe what they did. They have really, really streamlined over a period of 5 years their data sets. So they can run, they do nightly credit checks on all their tenants. So, and not just the tenants, the owners of the ultimate owner of the tenant and so on, to really, really pick up if a tenant is going into maybe slow down in the economy and so on, and what they do is really, really impressive.
Sure, his paper on behavioural psychology is pretty interesting as well.
I could talk about the footfall or movement of people. There is a startup called Guyana that is here in UK that is super interesting to really keep track of the footfall, and not just street during 1 week. They cover the entire England all the time. So you can find fascinating data.
Sure.
If you're in the retail.
An example of actually Matthew Richardson, it was fascinating what they've done, where they realized by putting it all together and gaining visibility to their fund, they realized the exposure to different type of tenants that they had across stocks and real estate was incredibly sort of underestimated. And if you say invest in DHL stock, and then you also list the premises to DHL in a certain percentage of your portfolio, then your exposure to certain tenant is increased. Whereas when these data sets were not talking to each other, the equities team would not even know how the real estate team would perform. So when you start looking at it across the entire set of different investments, it paints you a different picture.
Sure. Stephen, just to pick up on something you said earlier about, it's all well and good capturing all this data, but then it's actually using it. So how are yourselves at Aberdeen Standard sort of doing that? Do you hire new people who are data scientists? You're head of the PropTech group. Are you just a real estate bloke that learned about PropTech and taught yourself a new skill set? What's the best way of kind of, utilising all of this, these reams of new information that we have?
Yeah, I mean, I think that's a work in progress on our side. Obviously, Aberdeen merged with Standard Life. Last year, we had a global PropTech team. Standard Life had various sort of tech and innovation groups, so we've merged them effectively. So we're very aware of tech and the challenges and the opportunities, but what does that mean in practice? I mean, should we appoint a CTO? I mean, lots of people are, and maybe having that sort of chief technology officer is a really great addition, because it's somebody who actually really understands the tech, because in real estate, maybe we don't so much. As a house, we have a chief data officer, so collecting that data and trying to aggregate that and then predictively analyze trends from that is really important.
And Tatiana, same question for you. At Blackrock, are you sort of hiring people from MIT rather than Reading Real Estate and fellas with beards and chinos, etc., to do all this sort of stuff for you?
Yeah, I think it's a very good
ladies
question.
As well.
Yeah, very good question. I think the point on diversity in general is very important at Blackrock, because it's not, if you just hire mini yourself or mini someone else, and it's, for the team, then you're not going to get the kind of interesting edge that someone from a different background, say, as you just said, MIT, not Reading, or not a real estate typical degree, just brings different perspective to the team. And even though that person may not think the same way as you do, they just bring, that's something what you're, looking for. So we try to really challenge ourselves and bring these people in. In terms of PropTech, we do have a team that actually sits in US, and they do look either, what can you do? You can build it yourself, you can buy, or you can just put your head in the sand, which is not something we would like to do, of course. So yeah, we do have a team that focuses at PropTech.
I think on the evolution of real estate, though, 10 or 20 years ago, most guys would be RICS. They probably were cognate in a property-related degree. I think that has completely changed. I mean, partly because of the GFC, partly because of the way we work these days. But I think a lot of guys are now non-cognate in real estate. And I think certainly on the investment side, fewer and fewer people will be RICS going forward. Sorry to anyone from RICS in the room.
Sure. Start to go to a few of the questions from Slido. I appreciate everyone who's using that, because it makes my job a lot easier. Stephen, we were talking earlier, this point about valuation and how things like co-working, shortening lease lengths affects the valuation industry and how real estate is valued. I know you've got some thoughts on that.
I think it's a big issue today, because I think what the current valuation model in the UK does is use a very blunt all-risk yield to capitalise current and future income streams. When that is a problem, when lease lengths are getting shorter and shorter, tenants are becoming more fleet of foot, and they're actually looking for something different in their property. So that traditional, I'd like a 5-year lease and a 5A1 covenant is becoming harder and harder to find. So those long leases are becoming more rarefied, which is why they're becoming more valuable. So for me, as the guy who actually deals with the portfolio management and sells the space to people, if I can't sell them a 5-year lease because nobody wants a 5-year lease, because they want annual breaks, or they want to roll it on a monthly basis, if I can't provide that, then we're struggling as a house. The second point to that, though, is if I say to a fund manager, this is what we should do, this is what the market demands, the answer often is, well, that's not very good from a valuation point of view, because the valuer doesn't like that. So the valuer really is sort of valuing apples when everybody wants to buy pears in a way. And that's not the whole market, but the valuation system really needs to change and adapt to that. Maybe that's more of a cash flow approach rather than a pure capitalization model. But yeah, I think little has changed, but I think lots of valuers are talking about it, and it's becoming more of an issue.
How do we go about doing that? Because, saying the fundamental way in which real estate is valued is a pretty, sort of dramatic change the industry needs to go through. So how does that happen, Marcus?
I don't have
Magnus,
I don't have the answer, but I think quite a few valuers should go to Sweden because they take the co-working trend away. I mean, a normal lease length for offices is 3 years in Sweden. And somehow it makes the property market works, and it's very transparent and very a lot of large transaction volumes compared to capital.
I mean, I would also challenge when it comes to valuations. I mean, if you have a medium-sized law firm wanting to sign a 20-year-long lease, how do you value that compared to, a flexible workspace company that also wants to take, let's say, a 3-year lease or 5-year lease? I mean, is the law firm going to be still in business in 20 years' time? Considering all the trends that we see even in the legal space on the technology side. Okay. So that is, I think, the ultimate question is, do you value it in the same way?
I think that's where the data becomes really relevant, because again, I mentioned this tenant retention rate, and I guess what I think about a lot is not necessarily the length of the lease, but the length of the void. So, a really long lease is valuable, yes, in our model, but if I know that I have a building that I can consistently let with very little void, why is that less valuable? And in fact, why isn't it more valuable? And of course, we have more and more residential under management. And yes, those are very granular leases. Maybe the average lease length is sort of 18 to 24 months. But we've got 1,000 tenants. The chances are they're still going to be different tenants, but we will still be receiving rent on that building in a number of years, maybe more so than the law firm.
Yeah, I think it's focusing on not only on your cash flow, but on the customer experience, as it is everywhere else in other sectors. You cannot just treat your tenants as, that is a source of cash flow, but it's also the experience you're giving them, you being the landlord, and what they get out of it. Perhaps there is a factor to play, such as loyalty, etc. I mean, maybe that will become much bigger than we think at the moment.
Yeah.
Lisa, you're nodding along.
Yeah, just to resonate with what Tatiana was saying, we're actually sort of discussing it internally as well. So how can you value the brand? So to give an example where the building was sold to a Hong Kong investor where WeWork is, actually, is WeWork a risk or an asset to have in your building? And then does it generate additional kind of flow of tenants just because the WeWork is there? Or is it a major risk because they pretty much have quite dispersed tenant base, etc.? So how can you factor it in the valuation model? I don't think anyone actually addressed. And also the buildings over the long term will become more, again, rated by the customers. We believe that there is a space where when you go to TripAdvisor, Booking.com, you can see the rating of the hotel. Why offices cannot be rated by the users? And then when you as an investor, sort of, when you buy a building, you're not just buying cash flow, but you're also buying the tenant, and the tenant that wants to stay in the building over long term. And how is this factored in? And also the whole sort of, how do you value a building not on the lease flow as a fixed investment, but as a business? And then, with all the different lease lengths and how the buildings would be potentially diversified vertically. So all these questions have not been addressed by the valuation community, and we believe there is a room for improvement or for thought to develop further.
Given that TripAdvisor for offices doesn't really exist, is there any way of using other data to kind of create the same, to find out, how people actually, like a particular office or a particular area? Is there any way of bypassing it? Because I find it hard to believe that office users would ever kind of go, TripAdvisor, you're going to go on there because, everyone uses hotels day to day, but office users, they might not be as inclined to provide that kind of feedback. So how do you kind of get that feedback?
Well, normally, I think Rob Spire, CEO of Tishman Spire, talks about happy buildings. So when you actually, maybe there is a room for improvement to create this sort of startup where users can give feedback. Normally, it's the property team in the occupier space. So say if it's HSBC and they have property team that solicits feedback from the users. And there is a massive drive towards workplace efficiency, workplace customer experience. So if the the businesses and the users are not happy, they will channel this information through their property team, and the property team makes decision about the lease. So I guess this information will be channeled. It's not at the moment kind of directly from the user to the landlord, but I think there is room to have more instant feedback about the property.
I think also, I know this is very old-fashioned, but we actually go and speak to people as well. Yeah. So it's great if that's on the internet and it's aggregated and whatnot, but when we buy a building, we actually go and we speak to the tenants. You know, we do that inspection, we speak to the letting agents, we speak to perhaps the customers if it's retail. And often, you know, investment agents might try and take you on a tour the day that the grumpy CEO isn't actually in the building, you know, because the lift doesn't work very well, and you might mention that, or you might mention the heating system. So it's getting that. Sometimes you can get that from traditional sources. You know, it's not, tech gets it faster, but there are still other ways to get that information.
Sure. We've had a couple of questions on data sharing, which I think is an interesting topic. Obviously, in the world of tech utopianism, everyone shares data all of the time, but real estate, there's a value in being the only person that owns a piece of information. So there's a bit of a kind of paradox there. How again, the two investors, Tatiana and Stephen, how up for you are you guys about sharing data?
Very good question. I think there's a little bit of conflict that we eventually need to get over with ourselves. And you know, I like transparency, and I think that should be something that, you know, investors do share. Well, then as I mentioned in the beginning, the alpha, well, everyone will then get the alpha, and then it will be more about the beta and the idiosyncratic risk, and how you can really, really add value to your properties over time. So I'm up for sharing and transparency.
I think the data sharing will come. I think it's inevitable. I think the new culture will reward that. But ultimately, there's no denying that a lot of value in property comes from information which is not in the open market. Ultimately, it is an imperfect product, and if you're buying a building and you know something about that tenant that no one else knows, you can call it insider trading, but that is valuable to you as an investor. So clearly, I don't think the real estate market will open up everything, but I think there will be more sharing of that sort of universal data set that allows us to compare buildings on a more open basis.
Magnus, from your point of view, sitting on the outside of this, how can the industry sort of share data more without giving up that kind of proprietary advantage, do you think?
Yeah, that's the key thing. Everyone wants transparency, but just for themselves. That's interesting. Catch-22 to everything. I think, especially among the large companies, it's even a problem within that one company, because you're a large agent, you have different teams, and they don't even share the data within that brand. So that's a challenge, and the biggest challenge is that most of the data is not easy shareable because it's not put in a database. It's maybe unstructured Excel spreadsheets or in the head of the agent. So the first thing is to solve the technical issue to actually be able to share it. But of course, I mean, the overall is what should be shared. But I find it fascinating. I mean, we are in 3 countries so far, and each country works very, very differently. If you compare, for example, the Nordics, in the Nordics, we are much more transparent when it comes to ownership, the investment sales, that type of transactions. But the level of lease data that is available here in England, then you can question the quality. That's another part of it. There's nothing like that in the Nordics. So I'm always shocked that the agents can give away the rent rolls from the investors and no one is complaining, because if that was done in the Nordics, that would be a big change and a slight uproar. But everything changes over time, and that's the tradition of each unique market that differs a lot.
AMG's just compared you all to Orwell's 1984, which I think is a little harsh, but there's certainly a grain of truth in that. There's been a couple of questions again about kind of skills. It's something we've touched on, but you know, Lisa, I'll come to you. Are sort of traditional real estate firms doing enough, do you think, to kind of teach people the new skills that are being required? I mean, you seem very knowledgeable about. Are you sort of autodidact, sort of teach yourself about all this stuff, or is it part of a sort of cultural shift, do you think, and an institutional shift?
Yeah, so it's a very good question, and it's very topical. I think Stephen mentioned about the talent and the tech talent. So in the CBRE, for example, we did go through massive transformation over the last sort of 12 to 16 months. So we have global CTO, we have Lionel Hill, who's speaking on one of the panels today. So he's leading the innovation sort of tech team, digital and technology team. So we are hiring talent from outside. So a lot of our colleagues are coming from sort of investment banking background, having written software for 30 years for investment banks, and now coming across to sort of real estate industry. So my colleagues sort of, we are partnering with them. So we developed this agile approach where our digital and technology team is working with us very closely to help us develop different products or different solutions, and then we learn with them what the technologies are available so that we can upskill ourselves. Just to give you an example, we're working on this project where we try to collect all the data we have currently available within CBRE, and also sort of trying to capture bigger data sources to help investors identify undervalued assets and develop the global investment strategies. So we look now at AlterX or with Microsoft Azure. So, and this was sort of brought to us by our digital and technology colleagues. So I think the future of the analyst and the role of the analyst is going to change. I do believe that there's room for more sort of sophisticated analytics and working closely with your tech team to improve whether the way you collect data, the way you analyze that. So, and again, because a lot of talent is coming from different industries, I do believe that recent Reading graduates need to step up their game. And there is a more technology or more sort of skills that they need to develop that will enable them to be to work in a more analytical and complex environment.
Sure. I think that's a fantastic point at which to finish our discussion. Thank you so much, everyone from the audience, for your questions, and I'd like you to thank our panel as well, who've been fantastic. Thank you.